Most people who purchase properties these days require finance in order to do so. Whether the property is going to be your own home or an investment property, borrowing, or gearing as it's commonly known, is one of the fastest ways to increase your overall wealth. The word gearing can be used interchangeably with borrowing, so by gearing you're actually borrowing. Negative gearing is where you as the investor are prepared to take a bit of a hit on your cash flow throughout the years where the rent that you're receiving is less than the outgoing expenses that you're incurring from the rental property. The biggest of your expenses that's pushing you into the red is of course the interest on the loan. The logic behind negative gearing is that you lose money throughout the period that the property is being rented. However, provided that the actual value of the property or growth of the property is exceeding the amount you're losing due to the shortfall in rent against expenses, then everything will be alright in the end. However, like all investment strategies, it doesn't always work. Let's have a look at a simplistic example of negative gearing. Mr. T purchases a property for $250,000 in 1999 in Perth, and because he has other property as security, he borrows the full amount. Throughout the years 2000 to 2010, the property has increased in value from $250,000 to $400,000, and Mr. T decides to sell and realise his gains in 2010. This $150,000 difference between the purchase price and the current value represents growth or appreciation of the value of the property. After deducting all the sale and purchase costs, Mr. T is still left over with an overall capital gain of $120,000. However, between the years 2000 to 2010, when Mr. T was renting the property, the expenses exceeded the rental income, and for simplicity we will say that each year was identical. Over the years the property was rented out for $280 per week, and the expenses were reasonably consistent throughout. The rental property schedule for each year between 2000 and 2010 looked like this. The rent was $14,000. The interest expense was $17,500, rates were $1,000, body corporate costs were $1,000, agent fees were $750, depreciation was $2,000, and other costs were $1,250. The total costs were $23,500, which resulted in a net loss of $9,500. This net loss is where the negative part of the equation comes in, because this loss each year must be paid for, and it's Mr. T who must find the money to cover this loss. Mr. T has funded this loss each year, and on these numbers Mr. T was out of pocket approximately $183 per week. So Mr. T had to find $183 per week to keep this investment going. When Mr. T lodged his tax return for the years 2000 through to 2010, he declared all the income and expenses from all sources, including rental property income and rental property expenses. As such, he declared that he made a net loss of $9,500 from his rental property investment. Provided Mr. T had paid tax elsewhere, such as an employee, he would be entitled to receive a tax credit or refund as a result of this tax loss from his rental property investment. The tax refund or tax savings that Mr. T received are dependent on various things, such as his taxable income, the tax that he paid, and the tax rates. In brief, the lower Mr. T's assessable income, the lower his tax rate, and the higher Mr. T's assessable income, the higher his tax rate. Mr. T earned $50,000 per year throughout 2000 to 2010, and if this income fell into the 30% tax rate, This would mean that for each deduction or loss from a rental property, the tax office would tip in 30% of the loss, or in this case, the tax office would allow a tax refund or tax credit of $9,500 times 30%, which equals $2,850. The end result of this refund is that in real terms, Mr. T would receive an additional tax refund of $2,850 each year on top of what he normally received when he lodged his end-of-year tax return. This component would be solely related to the negative geared investment property. So the real cost of the rental property each year is actually $9,500 less the rental property component tax refund of $2,850, resulting in a true loss each year of $9,500 less $2,850, which equals $6,650. So if we say that the rental income and expenses were consistent for the 10 financial years that the property was rented, Mr. T would have been out of pocket $6,650 multiplied by 10 years, which is $66,500. When Mr. T sold the property in 2010, the net growth after deducting purchase and sale costs was $120,000. So Mr. T had made $120,000 from the net profit from the sale of the property less the amounts that he was out of pocket for the 10 years, which equals $66,500. The difference being the true profit of $53,500. Not bad considering the financial institution lent Mr. T the full $250,000 to buy the property in the first place. You could say that Mr. T made money from using other people's money, or more accurately, the bank's money. Before the global credit crisis, many financial advisors and accountants broadcasted the profits associated with gearing. It was all reasonably straightforward. Take a bit of a hit for a few years and then sell the property for a big profit. Provided that the property's value goes up and that the gain is greater than the amount of losses that were incurred throughout its rental period, then it's happy days. This financial strategy left the alternative of simply investing your hard-earned savings without combining them with borrowed funds for dead, as you were now using other people's money to make money. However, as many people are now fully aware of, properties don't always go up in value. In fact, sometimes they remain the same value for many years, and even worse, they reduce in value. There is absolutely no sound logic behind continually wearing losses for years on end and then finding out that the property has gone down in value, all the while you've been carrying it along. Negative gearing can turn out to be a complete disaster if you're not able to service the ongoing negative geared losses, because, let's face it, not everybody's personal financial situation can weather the storm of constant losses. What makes it even worse is that often taxpayers are reluctant to sell a property and take a loss and end up digging their feet in the sand for longer than they should, which simply increases their losses. The problem is that then this exacerbates further the problem when interest rates go up, and eventually, for those who can't hold on any longer, the property must get sold at a complete loss. The end result is that the taxpayer has paid large amounts of money to buy and sell the property, has incurred a loss based on the expenses exceeding the rent all the way through, and then either makes a measly gain from the sale, or worse still, an overall loss, compounding the entire investment as a complete dud. While it's true that negative gearing does have the potential to maximise profits, especially when times are good, The problem is that when times are not so good, it has the potential to maximise your losses. Much like a knife, if used in the correct way, negative gearing can provide substantial benefits. On the other hand, it can inflict severe pain if used against you. Not everybody is able to hang in the property market, patiently outlaying more and more money in hope that the market will soon turn the tide so that the investor will reap the fruits. I urge you to look into the variation, or the old 221D application, which can be completed and allows taxpayers to pay less tax throughout the year rather than hold on until they lodge their end-of-year individual tax return. The subject of variations, or the old 221D applications, is covered in another DVD produced by the Advice Bot. In times of increasing interest rates, more and more pressure is applied on the investor, and a review of the overall situation to ensure that the strategy is sound and not emotion driven is needed. If you are like many Australians who are mortgaged to the hilt and feel that another interest rate rise will be the final nail in your coffin, the best thing to do is to talk to an experienced advisor and get some good, solid advice. An experienced advisor can look at your situation from your corner and will not only take into account your financial circumstances, but your personal, non-financial circumstances as well. Issues such as lifestyle, cash flow, investment preferences, future plans, taxation aspects are some of the issues that should be looked at on balance if you are to receive comprehensive advice.